Hi, I'm Chris Wright, President of Wright Wealth Management Group, and today we're going to continue our conversation on annuities. On our previous podcast, we discussed the idea of immediate annuities or income-only annuities. We also discussed fixed annuities. The fourth type of annuities that we need to discuss are those that are referred to as variable annuities. The reason why the term variable annuity is associated with this type of investment is because the investment vehicles are considered variable subaccounts, which are similar to mutual funds. A variable subaccount is invested in the market and has daily pricing at the end of each day of the market, as would a mutual fund. Why would somebody therefore maybe want a variable annuity versus just a traditional mutual fund account? The reason why is some investors like to have some of their earnings tax deferred, and with a variable annuity using mutual fund type subaccounts, because the annuity is associated with an insurance company and has the tax deferral benefits of an annuity, the investor does not have any taxes or capital gains or ordinary income on those investments until they decide to take a withdrawal. That's unlike a regular mutual fund account that's held in a non-qualified account or a living trust account or an individual account. Many investors that have mutual funds held outside of an IRA often wonder why they have a tax bill at the end of the year, because of the capital gains that are associated or produced through the account by the mutual fund manager. For instance, if you had $100,000 in a regular mutual fund, that mutual fund manager may spin off or sell different stocks and buy others, and therefore create short-term or long-term capital gains within the portfolio because they're the portfolio manager. And with that account being a non-IRA account, it would be subject to the capital gains in the year in which they are earned. In comparison, those investors who want tax-deferred growth while still being in the market can use a variable annuity that uses the subaccounts, the variable subaccounts that really are very similar to mutual funds. And because of the tax-deferred benefits of an annuity account and having mutual fund type subaccounts in that annuity that are the investment vehicle, the earnings on those annuity accounts are tax-deferred. Thus, the investor has a little more flexibility in determining and controlling their tax bill because the earnings are tax deferred until the investor decides to take those earnings out of the account and receive those withdrawals. An additional benefit of the variable annuities is that the subaccounts can be changed throughout the year. If an investor feels that the market is moving in maybe one direction versus another, the investor and the financial advisor have the ability to reallocate or rebalance the portfolio several times throughout the year. In comparison, if we look back at maybe an indexed annuity, for the most part, an indexed annuity, annuity number 3 that we discussed, can only be changed once per year. But a variable annuity with variable subaccount investments that are in the market can be changed several times per year, depending upon current market conditions. That's an additional feature of the variable annuity. Additionally, if the market is having a terrible year, most of the variable annuities out there will allow the investor to move over to the sideline, to the money market fund or the cash reserves fund, and sit in that cash pattern until they decide to come back into the market. So there are some nice benefits of the variable annuity as well. In recent years, the variable annuities have added something called a living benefit rider. This is a guarantee that's been issued by the insurance company based upon their claims paying ability that says that even if the markets go down significantly, the investor may have an opportunity to take a 4 or 5% withdrawal based upon their original investment amount, or even maybe their highest anniversary value if the annuity allowed for an annual lock-in benefit. And the investor therefore could take a 5 or a 4% withdrawal for the rest of their life, even if their balances continue to go down in the stock market. We refer to this, and many insurance companies refer to this as a living benefit rider. If you're an investor that has current annuities, it's important to have your annuities reviewed periodically by an independent financial advisor that understands the different types of annuities that are available. Because things change over time and different annuity companies, insurance companies offer better portfolios and often better riders that are available, you do have the opportunity to potentially roll over your current annuity into another annuity strategy, thus benefiting your financial situation for the future, to take advantage of the better riders that are now available and also some of the higher participation rates that are associated with the indexed annuities. I'm Chris Wright. Thank you for joining us today concerning indexed annuities and variable annuities. We hope you enjoyed the information, and we hope you'll join us next time as we discuss other financial topics.